All right. So today we're going to start our next topic, which will be the first one covered on your next midterm, called exchange rate policy in the central bank. So every year, moving goods and services around the world actually becomes easier and easier, okay? Currently, the volume of international transactions in the world, as measured by like the global amount of exports and imports, is actually close to half of total world GDP. So international transactions of goods and services, flows of goods and services across borders, is a huge, huge component of the total amount of economic activity in the world. I think to fully understand the nature of these transactions, and what's important for this class is how these transactions affect or interact with monetary policy, right? That's the thing we're most concerned about in this class. We need to take some time to kind of refamiliarize yourself with a key concept in international macro that makes all of these trades of goods and services as well as assets possible in the first place. And that is exchange rate. So that's what we're going to do first today, is talk about what exactly the exchange rate is and how it measures the price of these things called foreign currency transactions. Hopefully, most of this will be kind of a review. Okay, so whenever you buy something that has been made abroad, whether it's something like clothing or a car, or if it's an asset that has been originated from a foreign country, like a stock or a bond, somebody somewhere has exchanged US dollars for foreign currency. Now, why is that? Anytime you buy something that was made in a foreign country, somebody somewhere has to have traded US dollars for foreign currency. When you guys buy that article of clothing in the store, the shop requires that you purchase those products with US dollars, right? But let's suppose that clothing was originally manufactured in a country like Malaysia, okay? The Malaysian producer of that article of clothing requires Malaysian ringgit, right? In other words, both the buyer and the seller in these international transactions want to be paid in their own domestic currencies. So somewhere along the way then, dollars must be swapped for Malaysian ringgit, okay? All cross-border transactions are like this, whether we're talking about goods and services or whether we're talking about assets like stocks and bonds, okay? So in the first part of this talk, we're going to discuss these exchange rates and how they help us measure these foreign currency transactions. But then what we want to do is actually talk about how we can determine these exchange rates in the short run. And we're going to develop a simple supply and demand-based model of foreign currency exchange in order to determine or analyze how exchange rates kind of move around over time. When you guys took your principles of macro class, you probably talked about a theory of exchange rates called purchasing power parity. Maybe you covered it in your intermediate macro class. That is a useful theory of exchange rates, but it's really more useful for understanding why exchange rates fluctuate the way they do in the long run. It's not a very good theory to explain these kind of week-to-week or even day-to-day fluctuations in currency prices. So in this class, we're not going to talk too much about purchasing power parity, but rather develop a supply and demand model of foreign exchange to better understand why currency prices move up and down over time. Really more important or more related to monetary policy then is we're going to talk a bit about how central banks can actually intervene in these foreign exchange markets, and the direct actions that central banks take are going to have an impact on the monetary base. So just like open market operations by the Federal Reserve can affect the monetary base and therefore the money supply and therefore economic activity. Actions that central banks take in the foreign exchange market can also affect the monetary base. So we're going to talk about how those are similar to one another. I won't get to this today, but in the next class, we're going to analyze how these foreign exchange interventions by central banks can influence the country's exchange rate. Now, it turns out that the Federal Reserve, our central bank, very seldom intervenes in these foreign exchange markets. So some of you might already be wondering, well, why are we really talking about this all that much if the Fed doesn't really intervene in these markets that much? And that's why, one of the reasons why I've called this exchange rate policy and the central bank. Because it turns out that lots of central banks across the world actually do frequently intervene in foreign exchange markets to try to either peg their exchange rate or at least manage the fluctuations in their exchange rate. Lots of countries, their own economic activity, their own kind of domestic economic conditions are highly sensitive to exchange rate fluctuation. And so their central banks take measures to try to manage them as much as possible. And so we'll talk about how that plays out. What can the central bank do to raise or lower or even peg their exchange rate? And then lastly, we'll talk about some of the costs and benefits of policies that actually fix the exchange rate. There are still a handful of countries that practice a fixed exchange rate regime. Most countries today allow their exchange rates to float, either completely free or they manage them somehow. But some still do try to peg their exchange rate. And so we'll talk a bit about the pros and cons of those different exchange rate policies. Okay, so today markets for most goods and services, as well as financial assets, are global. And as a result, the volume of international trade, the volume of our exports and imports as a share of US GDP has actually gone up quite a bit over time. If you take a look at data back from like the 1960s, only about 5% of our GDP was accounted for by international trade, whereas today it's something closer to 20%. And of course, for many countries across the globe, it's much higher, 50, 60, 70%, okay? When individuals or firms in the United States import or export goods, or they perhaps want to invest in assets that originate from another country, what they're going to need to do is be able to convert US dollars into some amount of a foreign currency, okay? This brings me to our first term here today, and that is the nominal exchange rate. Now, what is the nominal, what's the straight definition of the nominal exchange rate? It's simply put, it's the price of one currency in terms of another currency. Okay, so let me just give you a straightforward example. So this weekend when I was revising the slides for this section, I went out and looked at actual exchange rate data between the United States and the Japanese yen. So on October 4th, 2020, one US dollar could purchase 105.55 Japanese yen, okay? So that's how we represent the nominal exchange rate in this example. It would be 105.55 yen per dollar. Or alternatively, we could flip the exchange rate on its head and express it equivalently as $0.009 per Japanese yen. Okay, now, with that said, pretty much all the time in this class, I'm going to adopt a convention so that you guys don't get confused by this. When we're talking about exchange rates, I'm going to discuss them in terms of units of foreign currency per unit of the domestic currency. So even though these two exchange rates are equivalent, one is just the reciprocal of the other, I'm going to express exchange rates in the first way here. That is units of foreign currency per unit of domestic currency. Now, in practice, some exchange rates kind of have their own convention. If you guys go out and look at data on the US Euro exchange rate as an example, typically that's published in this form. That is dollars per euro, okay? But I want everybody to not be confused by this. So when we talk about exchange rates in this class, it's going to be units of the foreign currency per unit of the domestic currency, which in most examples we'll just assume is the US dollar, obviously. There's lots of websites, by the way, or sources for exchange rate data. The Federal Reserve Bank of St. Louis publishes a lot of it, but you can get real-time quotes on this website called xe.com, which is where I got those. Really simple to do. You can just select basically any two countries in the world, and it will show you what the current spot nominal exchange rate is between those two countries. Okay, questions so far? All right, so it's important to note that changes in exchange rates can affect the prices that consumers pay domestically for goods that are produced abroad, that come from foreign markets. Let me say that again. The price that we pay for goods and services that are produced abroad can change for us simply by virtue of changes in the exchange rate, even if the price of those goods in the foreign country hasn't changed at all, right? So this adds, when we talk about international trade, there's another element of price risk that comes from changes in the actual exchange rate. Okay, let me give you, here's an example that I thought of. Let's suppose that a Sony PlayStation costs 30,000 yen in Tokyo. It's produced in Japan, okay? What is the dollar price then for a US consumer for a Sony PlayStation? Well, Santiago, go ahead. Exactly. You just take the yen price of that good and you divide it by the US dollar yen exchange rate. In this case, 105.55 yen per dollar. And you see here in this ratio that the yen units will cancel and you're left with $284.23, right? So given an exchange rate of 105.6, basically, the US price of a Sony PlayStation is $284, okay? My point with this example is that the price that US consumers face can change simply by virtue of the exchange rate changing rather than the underlying cost of the product, right? What happens to the dollar price of a PlayStation if the exchange rate, let's say, falls to 100 yen per dollar? Just do the same calculation and you get exactly $300 in this case. So what do we witness here? That even though the price of a PlayStation in Japan has not changed, if the exchange rate between the yen and the dollar goes down, that's going to make the domestic price that we face more expensive, right? The price is going to go from $284 to $300. Okay? Exchange rates fluctuate every single day, every single minute, really, okay? What figure 5.1 shows you here is the dollar-yen exchange rate from, what are the dates here? From August of 2000, I think, to August of 2020. So a 20-year period here. Now, again, to be clear, and I got this information, by the way, from the Fred website, St. Louis. The exchange rate here is represented in Japanese yen per US dollar. So exactly the way we've defined it in this class, okay? What the graph basically shows you then is how many yen swap for $1 US at any point over the last 20 years. And you see that that exchange rate has moved around quite a bit over the past 20 years. It's fluctuated. Well, in 2000, it was around what, 105 to 110 yen per dollar. By 2002, it was trading much higher at about 135 yen per dollar. But then way over here in 2012, the exchange rate got to a low point over the last 20 years, down to about 75 yen per dollar. So you see that the exchange rate can sometimes fluctuate dramatically over time. That's about at least a 50 percentage point swing in the exchange rate from high to low. Okay, an increase in the yen-dollar exchange rate in this example, or just in more general, an increase in the price of one country's currency relative to another has a particular name in economics. We call it an appreciation of the exchange rate. You may have heard of this term before. Sometimes it's referred to as a strengthening of the domestic currency. I'll use that term a lot. When we talk about the dollar strengthening relative to a foreign currency, we mean that the dollar is appreciating. That is, the nominal exchange rate is rising, right? A dollar buys more and more units of a foreign currency, okay? According to the data here, when was the dollar strengthening relative to the yen over the past 20 years? Early 2000s, right? Mid 2000s, like 2004 to 2007 or so. And it strengthened from, let's see, 2012 to about 2015. So each of those three periods was a time in which the US dollar was strengthening relative to the yen. The opposite movement in the exchange rate is called a depreciation, of course, right? That's when, in this example, the yen-dollar exchange rate would be falling, right? That's a weakening of the US dollar relative to the yen. When the exchange rate falls, every single dollar is purchasing fewer and fewer Japanese yen in foreign exchange markets. And we can see from the graph here that occurred, you know, in 2002 to like 2005, and then, you know, certainly during the financial crisis from 2007 all the way to about 2012. In recent years, however, the yen-dollar exchange rate has been pretty stable, around 105 to 110 yen per dollar. Before we go to the next slide, let me ask you guys really quick. What parties would benefit from an appreciation of the dollar? When the dollar is strengthening, who benefits from that? Michael? Sorry, say again? Yeah, so, okay, we'll be a little bit more specific there. What do you mean by that? Mm-hmm. So, okay, let's be careful about this. If the US dollar is appreciating, so the dollar is strengthening, then every single dollar is now purchasing more and more Japanese yen. So I can think of, and maybe this goes to what you're saying, I can think of basically two types of people that would benefit from that, right? One would be US consumers that are interested in buying Japanese goods and services, right? Because now every dollar you have is more valuable in terms of yen. And so all of a sudden you're able to buy more Japanese goods and services for the same amount of money. So US consumers certainly benefit. Now, who else would benefit though? And maybe this speaks to what you were saying. Business interests in Japan that like to export their products to the US, right? Because now Japanese products are suddenly more competitive in these global markets, right? US consumers can afford more of them. So Japanese exporters to the US would benefit, as well as US consumers. By that logic, who benefits from a depreciation then of the US dollar, or a weakening of the US dollar? Or alternatively, a strengthening of the Japanese yen? These would be Japanese consumers of US products, right? Or another group might be US business interests that are trying to sell their products in a foreign country, in Japan in this case, right? This is why US businesses are always complaining about a dollar that is too strong, right? Because when the dollar strengthens, the goods that our manufacturing companies produce becomes more expensive in global markets, right? The cheaper our products are in global markets, the more competitive our own domestic industries are. So be aware from that. Is there are different parties that benefit from a strengthening versus a weakening of the US dollar. Okay, so as we saw there on the previous graph, exchange rates move around over time, and they sometimes can move around quite a lot. It's not uncommon at all for exchange rates to fluctuate by several percentage points on any given day. Our goal in this portion of the class is to try to understand what sorts of events or phenomena are responsible for these kind of constant movements in the exchange rate over time, okay? Now again, let me just emphasize that, you know, in your intermediate class, you probably spent a fair amount of time talking about this theory of purchasing power parity. That is a useful model of exchange rates to understand appreciations and depreciations in the long run, right? Do you guys remember I don't have this in the slides, but do you remember what purchasing power parity says? This idea that a basket of goods and services should basically be the same price wherever they're sold. It's based on the law of one price. So that, for instance, the foreign price of a product, let's say a Sony PlayStation in Tokyo, should basically be the same price as a US PlayStation once you convert US dollars into Japanese yen. You shouldn't be able to, you know, buy a PlayStation in the United States and sell it in Japan and make a profit, right? That's what the theory of purchasing power parity says. It's based on the law of one price. And in the long run, it says that exchange rates move around anytime there are differences in the inflation rates between two countries. It's a useful model of understanding some fundamental features of exchange rates. Unfortunately, it doesn't do a very good job of explaining these kind of day-to-day or week-to-week fluctuations in exchange rates. For that, you really need to talk about it in terms of a model of supply and demand, which is what we want to do today. Okay, so economists use supply and demand models all the time when we want to try to determine what factors cause the market prices to move around. If you go all the way back to your micro principles class, if you want to think about what factors cause market prices to fluctuate, you do that in the context of a simple supply and demand model. Well, that's exactly what we're going to start doing today, okay? What is the exchange rate? That's just the price of domestic currency, or I'm sorry, it's the price of foreign currency in units of domestic currency, or vice versa, right? In other words, the exchange rate is the price of foreign currency exchange. So if we want to think about what causes exchange rates to move around over time, what we want to do is develop a simple model of the supply and demand for that foreign currency exchange. All right, and that's exactly what we are going to do today. So before we do that, I need to make one thing clear. And when you're talking about these models of foreign exchange, you need to be very clear about establishing the difference between the home country and the foreign country, all right? Because that's going to make all the difference when we're defining the price and the quantity of the good in question in this supply and demand model, okay? The natural choice for the US, of course, is to just simply make the United States the home country in our examples, and that's what we'll do, okay? And that means then that the exchange rate, as we've defined it, in units of foreign currency per unit of per US dollar will be the price of foreign exchange in this market. Okay, so let me talk for a few minutes now then about supply and demand for foreign exchange. So who is it that supplies US dollars to the foreign exchange market? So I keep using that phrase, foreign exchange. We are the home country, right? The US is the home country. There needs to be some source for the supply then of US dollars that are going to be exchanged or converted into Japanese yen in our example, okay? What is ultimately the source of the supply of those dollars? Well, really there are two sources, right? Or there are two reasons why someone who is holding US dollars would want to convert those US dollars into Japanese yen or some other foreign currency, okay? One source of the supply, well, both sources basically come from US residents, okay? But one of those residents would be US consumers that want to purchase foreign products, all right? So Americans have a large stock of US dollars. To the extent that we want to purchase products that are made in foreign countries, we're ultimately going to have to supply US dollars to foreign currency markets that will be exchanged or converted into Japanese yen. But there's another group that is also supplying dollars, and that is US investors. Perhaps this group is more important. So there are US investors that may want to purchase assets originated in Japan, stock in a Japanese company, right? A bond issued by a Japanese company or the Japanese government, okay? So US investors will also supply dollars to the foreign exchange market if they want to purchase foreign assets. So it doesn't just come from consumers who want to purchase foreign goods and services. Now let me ask you this question. What do you think happens to the quantity of US dollars supplied in these markets if the exchange rate goes up? That is, the dollar strengthens. That is, the price of a dollar compared to a unit of foreign currency goes up. What happens to our willingness to supply dollars if we see a strengthening of the US dollar? You think it goes up or goes down? What's your name again? Derek, why do you think it goes up? Whether it's consumers who want to purchase foreign products or US investors who want to purchase Japanese assets now, if our dollar is strengthening, then the price of Japanese goods or the price of Japanese assets are now becoming relatively cheaper to us. So we're more willing then to supply those US dollars to be converted into Japanese yen. In other words, the supply of foreign currency exchange is upward sloping. As the exchange rate goes up, our quantity supplied should go up as well. Here's a simple little example to illustrate that point, okay? Derek, let's suppose that you are planning on buying a new car, okay? You've narrowed your options down to a Honda Civic and a Ford Focus, okay? How will an increase in the yen-dollar exchange rate, that is an appreciation of the US dollar, affect your decision? So right now you're completely indifferent, but all of a sudden you wake up today and the dollar has strengthened relative to the yen. What has happened? The Honda Civic has now become cheaper, right? Every dollar you have can purchase more yen, and so the Civic is now going to be cheaper to you than the Focus, right? And so you're going to be more willing then to supply those dollars in foreign currency markets. All right, the more valuable is the US dollar, the more likely US consumers and investors will be willing to supply those dollars to foreign exchange markets. Very good. How about demand? So who is it that demands US dollars then in foreign exchange markets? US residents are the suppliers of dollars, but where is the demand for dollars coming from? Well, foreign consumers who want to purchase products made in the USA or services that are provided here, or alternatively, and this one I think is probably the most important, is foreign investors who want to purchase assets that originate in the United States. Maybe they have a higher return, maybe they're not as risky, whatever the case may be. When foreign investors want to buy US assets, they have to acquire dollars to do so. So there's some conversion of foreign currency into US dollars. Okay? What do you think happens to the quantity of US dollars demanded from abroad as exchange rates fall? So let's say that the US dollar weakens. That is, our exchange rate depreciates compared to, let's say, the Japanese yen. What's going to happen then to the quantity of US dollars demanded? It's going to go up, right? As the dollar weakens, every Japanese yen can now purchase more and more US dollars. So US goods become cheaper relative to Japanese goods. US asset prices become cheaper relative to Japanese asset prices. So the demand for dollars from the rest of the world goes up when the US exchange rate declines, when the dollar weakens. In other words, the demand for foreign exchange in our example is downward sloping. Supply goes up, demand goes down in the traditional way. I know all of this is, these foreign currency transactions can sometimes be tricky, okay? So let me just give another concrete example of why these relationships hold the way I've described. Let's suppose we've got a Japanese college-age student who has been admitted to Kyoto University and Northwestern, okay? How will a decrease in the yen-dollar exchange rate affect her decision? So this morning she's indifferent between going to Kyoto University or Northwestern. All of a sudden the dollar weakens relative to the yen. What happens in that case? US goods and services become cheaper relative to Japanese goods and services. And so all else equal, she may prefer to enroll at Northwestern relative to Kyoto University, right? But to do that, she can't pay with Japanese yen, right? They only accept tuition in terms of US dollars at Northwestern. So she's going to demand more dollars in exchange for yen in foreign exchange market. The cheaper the US dollar, the more likely foreign consumers and investors will be willing to demand those dollars in foreign exchange markets. Okay, questions so far? We know what a nominal exchange rate is. We know the convention on how to express it, units of foreign currency per US dollar. We know the difference between an appreciation and a depreciation. We know who benefits from either one. And now we have some idea about what might determine these exchange rates in the short run. That is the interaction of supply and demand for US dollar foreign currency. Okay, let's put these two things together to analyze what's going to happen in equilibrium. Okay, so you'll be expected to understand and be able to apply this pretty straightforward model. So again, we're talking about the particular good that we are modeling the supply and demand of is essentially the quantity of US dollars that are available for exchange into some foreign currency, in our example, yen. So the good that is graphed on the horizontal axis here is the quantity of dollars. I'll sometimes refer to that as foreign exchange. It's the quantity of US dollars that will ultimately be swapped for Japanese yen in this case. What's the price of that foreign exchange? It's the nominal exchange rate expressed as yen per dollar. When you guys graph this stuff on your lab or on an exam, be really careful. I want to make sure you understand this is quantity of US dollars, and the exchange rate here is depicted as the foreign currency per US dollar. The demand curve slopes down for reasons that we just talked about, right? The supply curve slopes up as the exchange rate declines. The quantity demanded of dollars from the rest of the world goes up. As the exchange rate rises, the quantity supplied of US dollars to be swapped for Japanese yen that's originating from us is going to go up because our dollars are worth more. Okay, and you guys know the rest of this story, right? This is a straightforward, perfectly competitive supply and demand model. Foreign exchange markets are as close to perfectly competitive as you're going to get in this world, okay? What we should see happen is that the price of foreign exchange, that is the exchange rate, should move around in real time to balance demand and supply, which would, of course, occur here right at the intersection point in this simple little model, okay? Oops. So just really quickly here, let's imagine for a moment that the exchange rate was up here somewhere. It was set too high. Currently, the dollars are overvalued relative to the yen, let's say. Then what do we have? What situation do we have? We have the supply of dollars in foreign exchange markets exceeds the demand. So we have suppliers of dollars, that's us, competing over scarce buyers of dollars. That's foreign consumers and foreign investors. So we have what? A surplus of dollars then in the foreign exchange market. And so what's going to happen? The exchange rate or the price is going to be bid down until supply balances demand. Right? What happens if the exchange rate is too low? For whatever reason, it looks like the dollar is undervalued. Then you have exactly the opposite situation. The demand for dollars from the rest of the world exceeds the supply. So you have a shortage of dollars in foreign currency markets. So you have buyers of dollars competing over scarce sellers. In a perfectly competitive world, what happens to prices then? They go up, and they will continue to rise until demand and supply on the margin balance one another, right? That's what determines the nominal exchange rate in the short run. Now, there's a key implication here. And what is that? Anything that disturbs the supply or the demand for US dollars that are to be swapped for Japanese yen, that is, might shift around the supply curve or shift around the demand curve, is going to cause the equilibrium exchange rate to move around. Those fluctuations in the exchange rate that I showed you guys a couple of slides ago on the graph, those are caused by the continual interaction of supply and demand moving around over time, okay? In the next class, we're going to talk about several economic factors that might actually cause demand or supply to shift, and therefore the equilibrium interest rate to move up or down, okay? So I've got about 5 minutes left of class. Let me go ahead and stop the lecture today. So I have a couple of minutes to hand out your lab assignment, and then you guys can go and we'll try to finish up this material in the next class, okay?